Hi, my name is Rod Cleef, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Cleef, and I'm thrilled you're here. And I know you guys are going to get tremendous value from the two gentlemen I'm interviewing today. It's Ryan Webster and Warren Dresner, and they're with Equity Yield Group. It's equityyieldgroup.com. And, you know, they're in a couple thousand doors, and some really interesting things I read on their bios, like their first deal was $26 million. So I'm really excited to get into this interview and drill into a lot of these topics that these guys are obviously very well versed in. So welcome to the show, guys.
Thanks for having us.
Yeah, absolutely. So I don't know, maybe each of you could just take a minute and, or a couple minutes as it were, and talk about, why multifamily, how you got in the business. Just give us a little background, if you would. So Warren, you want to start?
Sure. So my background's in finance and insurance. Spent about 20 years in the corporate world. I'm from Australia originally, but my job took me to the UK and Europe and brought me to the US. I started investing in real estate in 2010, and it was all single family, and it was really driven by tax benefits. That was the primary motivator. Slowly over time, I became more interested in passive income and building up passive income. And around 2019, I started investing as an LP, as a passive investor in real estate syndications and multifamily. Soon after that, I met Ryan. We joined forces and we started to be more active in the space. So it's kind of developed from single family, tax benefits, passive income, and then more to operations.
Very interesting. Yeah, you guys have that, what do they call that? Gearing, negative gearing or something in Australia?
In Australia, there's a lot of differences. Negative gearing. They've also got all the lending is variable rate as well.
No kidding.
Fixed interest rates. So it's interesting.
We won't go down the political rabbit hole with Australia right now. Anyway, we won't digress. Ryan, please tell us a little about you, buddy.
Yeah, absolutely. So I've been in real estate in one form or another for most of my career. Prior to getting into multifamily acquisitions, I owned and operated a construction development company here in the Midwest for around 10 years. Did a lot of single family developments, small commercial strip malls, some small multi, and then transitioned into kind of a different model in the buy and hold as opposed to the build and sell, which comes with a little less stress, a little less executional risk, and some tax benefits that you don't get with the build and sell model.
Right. So where are you at in the Midwest, if I may ask?
Cedar Rapids, Iowa.
Okay. Yeah, I spent a lot of time in Denver, and I'm just curious where you were. Yeah. So you guys joined forces in, did I hear 19 or 20, or when did you guys join forces?
It's been 2020.
2020. Okay. And your first deal together was a $26 million acquisition. Yeah. Using institutional money. Well, talk about that deal. How'd that come together? And I mean, obviously you both had background in real estate, and so it wasn't like your first deal of all time. It was just, your first big multifamily, but where's it located? And this was in 2020. Is that when you bought it?
Yeah, it actually closed early 21, but we got it under LOI towards the end of 2020. Mm-hmm. So we were both looking for deals. We probably underwrote 150, 180 deals before we found this one. So it wasn't the first one we'd been looking at. Right. We were working together, underwriting, touring properties. We'd gotten close many times before. This particular one was interesting. It's in Sarasota, Florida, which I think might
really
where you're based.
That's where I live. Yeah,
a great part of the world.
So it's a 2016 built property. Is located in Sarasota, Florida. Which, as far as markets go, is a great growing market in Florida. And you think, 2016 build Class A property, it looks nice, but there was some opportunity in the unit interiors. The developer got pretty cheap on the finishes. So it was a nice community, well amenitized. Exteriors looked great, but the interiors, instead of being 5 years old. They looked 20 years old, 25 years old. So there was some value add component to it, even though it was a 2016 build, which was nice.
How many units?
148.
Nice. Okay. Well, boy, did you guys time that one well. We have one asset here in Sarasota, but it's income restricted. It's an age restricted community. And I have a friend that lives in an apartment complex here, she's in a 2-bedroom, and they raised her rent $1,200. So she went from, I think it was 1,800 to 3,000. Like, holy
wow.
shit. I mean, just insane. I mean, this Tampa MSA, as you know, is one of the fastest growing. I mean, you guys have certainly capitalized on that, I'm sure, but what an awesome first deal. So since then, you've closed on 130 million in multifamily assets. Yes.
Yep.
Right? Yeah.
Most of which is in the Sarasota, Bradenton area.
No kidding.
Most recently, back in December, we closed on the property behind me, which is in Bradenton, Florida.
Beautiful. Yeah, that's a beautiful asset. For those of you guys that can't see, it's 4-story buildings. That's fairly new build. Yeah.
Yeah. So we bought it directly from the developer. We put it under contract. It was only 70% occupied. It was 99% occupied when we closed. Very nice.
Very nice. That's a beautiful asset, right? Is that on the Manatee River?
It is.
Oh, wow. Look at that. Gorgeous. Gorgeous. So, well, good for you. I mean, you guys are definitely in the right market. We're very bullish on Florida as well. And I was looking at assets in Jacksonville a couple of weeks ago, and really love this market for a lot of reasons. The political environment, and of course, there's just so many people moving here. It's crazy. So let's talk about how you underwrite your deals and how you stress test your deals, and really what you look for when you're looking at an asset. Let's go there. And I don't know which of you wants to talk about that.
You go for it, Ryan.
Okay. First, it does start with the market for us. We are investing in real estate, but more than that being commercial real estate, we're investing in a business that happens to be attached to and inside of some real estate. So we start with the fundamentals of the market and dig in there and select an area that we want to be investing in, and then look for good opportunities within that area. And as far as, the deal specifics, it's really about creating a roadmap between, the existing performance of the asset and, what we think the asset could perform at in the future.
Sure.
And that's driven, fundamentals do drive rent growth. When you have, limited supply of housing in the area, you have growing population, putting demand pressure on the area. But then you have to get a little more granular at that and look at the exact product type against the competitive product in the area, and
Sure.
really assess, is there a delta between what rents are now and what the competitors are today. We don't like to just jump and forecast, well, things are going to grow. I know we're on par with the competitors today, but the whole comp set's going to move, and that's going to drive growth. Yeah, you see some of that in these stronger markets, but we don't like to hinge the whole business plan on this organic growth.
Right. Well, I got to tell you, I do believe you're gonna be able to capitalize on the organic growth as well in the market that you're in, for sure. So you're going to get both. Fantastic. So what do you do to stress test?
Absolutely. Again, you're in the underwriting, you're taking some known data from about the existing property performance. And then you got to make some estimates about future performance. And that's where the stress testing comes in around, well, how accurate are your estimates, and what happens if you miss on one of those data points. A lot of that comes into, reversion cap rate and what we're gonna sell the property for. So, we'll move the cap rate up and down and see if we can still generate a return range that's acceptable, return profile that we're targeting. And another big thing right now is the debt. With the volatile debt market. A lot of deals, especially in these bigger markets, cap rates have compressed. They're very tight cap rates going in. And the fixed rate debt just doesn't size on a lot of these deals,
Right.
Which is okay. You can use variable rate debt, and we do frequently, and a lot of people do. But you have to understand how variable rate debt works, and you have to model appropriately as to what your debt service is going to be. If you're planning on a refinance, what your leverage is going to be on that refinance in terms of the debt service constraints in the future.
Right. Which are difficult to forecast, but yeah. So on your exit cap, what sort of a adjustment do you typically make per year, for example?
It depends on the class of the asset, but we're looking anywhere from 10 to 20 basis points escalator per hold year.
Gotcha.
But we're also looking at, sales comps, price per unit. We like to exit at a price per unit that's been seen in the market already. We don't like to be exiting at a price that hasn't been realized yet. So that gives us a little bit of comfortability knowing that we're not trying to prove the new ceiling of what is a purchase price in a market.
Gotcha. Now, I know on that first deal you used institutional money. Can you speak to that a little bit? How that came about, and maybe give us a little more insight on the structure. How you put that together.
Yeah, absolutely. So coming from the development construction side, a lot of those deals, the capital stack is highly leveraged, where you'll have equity, preferred equity, or mezzanine debt, where the common equity slug is typically only bringing 5 to 10% on a development project. So it was a capital stack structure that I was familiar with from my prior career. On this particular deal, we went in with a floating rate Freddie loan for the senior, and then we had a preferred equity through Electric Capital that brought the total leverage up to 88% on that deal, and their return was capped at 14%.
Nice.
I think a lot of it comes down to the fact that we've always been very intentional about our strategy. We knew that we were targeting these newer builds in strong markets. It was going to have a high sticker price. So we had to have a strategy to be able to raise a lot of equity. So very early on in the piece, we started building relationships with some of these institutional groups. And so it's not that we found this deal and then had to scramble to find the equity. We already had the conversations going. And I think that made a big difference in making it work in the end.
Nice. I got distracted for just a moment when you were talking about who was the institutional player you brought in? You said the
Electra
okay.
Capital.
Okay. And they now, have you also worked with, for example, family offices, or they're a private equity group, correct? Electric Capital.
Yeah, Electric Capital. They're a subsidiary of American Landmark and American Landmark's REIT.
Okay, gotcha. Okay.
We haven't done a deal with a family office yet. We've talked to a number. We're pretty agnostic. We want to build these relationships and see which one makes the most sense for each deal. So we've done equity, we've done JV equity, we've done mezzanine debt. We haven't actually done a deal with a specific family office at this stage, but
gotcha.
Maybe on the next
Interesting. One. So are you guys vertically integrated, or do you hire third-party property management down here?
We have a third-party property manager that we use, ResProp. And we like them quite a bit. And one of the things that resonates with us is, so they came about as vertical integration of Vesta. So they used to own about $1 billion worth of real estate. Midway through building that portfolio, they decided that they were going to vertically integrate. They built out the property management company ResProp to manage their own portfolio. Since then, they've disposed of about 99% of that portfolio and are now focused almost exclusively on third-party management. But what really works for us with them is they were owners once. They owned and operated real estate. They had an asset management team, so they really understand our needs as owner operators.
So let's talk about asset management for a minute, because obviously you're still communicating with them on a weekly basis, most likely, and keeping track of your asset. So talk about talk about maybe how that communication happens, and how you measure your KPIs on your assets, and maybe some of the things you look for. That'll certainly add some value. Can you speak to asset management a little bit?
Yeah, absolutely. And like you said, it's really about KPIs and measuring, projections versus actual performance. So we meet with the property manager on a weekly call. and having conversations throughout the week with the operation team on various topics. But it's really about comparing realized performance to what our projections were when we laid out the pro forma business plan, and making sure that we're outperforming or at very least are on par. So we track really everything: lease trade outs on renewals, leases on new leases, occupancy, and then line item by line item, the operating expenses.
Open work orders,
Yep.
things like that as well, I'm sure. And by the way, guys, those of you listening, I just completed a book on asset management that I'll be giving you for free. Those of you listening, I just don't have it set up in a text campaign yet, which I'll get together, and it'll be one of the books that I give. But really proud of this. We just finished it. But you talk to them weekly. You're looking for anomalies. You're measuring all those things. Are you happy with what you're seeing on lease tradeouts in your market here? I know you are. I know you are.
Absolutely. We're definitely we're exceeding projections on all of our owned assets. Again, which is why we invest where we invest. It's a lot easier to have the tailwinds pushing the business plan along instead of facing headwinds.
Absolutely. So tell me a little bit about the team dynamic between the two of you. Do you both kind of do the same things, or have you fallen into individual roles now that you've taken down a good chunk of assets? Can you speak to that a little bit?
Warren, I'll let you jump on that one.
Sure. I think naturally we gravitate to where our strengths are.
Right.
When it comes to big decisions, though, we're both very much involved. So Ryan might underwrite a deal, I might underwrite a different deal. If it starts to look interesting, we bring the other one in and start to talk about it. Ryan's got that construction background, so when it comes to asset management, a big component of that is construction management. So Ryan is a lot more involved in that side of the business than I am. But the other aspect is this business is about teamwork. We need a bigger team to be operating these properties and taking them down. So the property manager is a key component of that team, but we also partner with other syndicators and other groups.
Do you?
Yeah, absolutely. So it makes it more fun when you partner with other people. But
Sure.
that's probably a side of the business that I gravitate more towards, trying to build those teams and interact with partners and make sure that we've got the right partners and the right team for each job. So yeah, the big decisions, we definitely look at them together, but we naturally gravitate towards where the strengths are. And then when we're both weak, that's where we look for a partner.
Are you both working with investors, or do you do more of that, Warren? How does that work?
Yeah, we both do interact with investors. I tend to be focused more on the marketing side of the business.
Marketing. Okay. Marketing to prospective investors, so on and so forth. Got it. Okay. And so, talk a little bit about one of the bullet points in your bio as a conversation point that I like is the importance of transparency and regular communication between teams and investors both. Can you speak to that a little bit?
It's just something that's always been important to both of us, actually. I mentioned at the beginning, I've been a passive investor in a number of syndications, and so many of them have poor communication. The investors are left in the dark.
Yeah.
You don't know what's going on. When you do finally hear from the sponsor, they're very brief and they don't actually tell you the full details.
Yeah.
So again, we were very intentional about this from the beginning. We want to be transparent. Every month we send out an update. We send it on the same day every month so that investors know it's going to come out. We share the full financials that the property manager provides us. It's just so much easier to build trust that way. We're not going to hide everything. Obviously, there's a lot going on day to day, and we don't share every single detail. But anything material, we try to show that transparency. Just
good or bad, right? Yeah.
Absolutely. Yeah. I mean, when it comes to bad news, it's important to share it and set expectations early, because if investors find that out much further down the line, I think you're in a position that you can't come back from.
Right. Agreed. No, I agree completely. We talked about institutional money, and there are positives and negatives for sure. Speak to that a little bit. Speak to, obviously the positives are access to bigger chunks of cash, but talk about the potential, negatives.
Yeah, absolutely. And then this is something that, a lot of people may or may not realize about institutional equity, but, the kind of potential downside to taking a large slug of equity from institutional partners is they're a lot closer to debt than they are to common equity, in that there's some caveats that come with it. And there's some strings attached to that money. And as you get into negotiating the operating agreement with this equity partner, you have to have first a keen understanding of who it is you're working with, and what is it going to be like working with them if things don't go to plan and you have to pivot. Are they going to be a problem solver? Or are they going to work with you to get through any potential issues? Or are they going to pull the ripcord and leave you high and dry?
Yeah. Yeah. And so they exert control. And that's the thing I wanted to make sure we chatted about on that, in that, they can be a godsend, but they can also, if things do go south a little bit, for example, we bought an asset in Lexington that the guy didn't want to sell, but he had private equity involved, and they dictated that he needed to sell because they needed to be out of that asset for their reasons. So you really want competent legal counsel involved helping you, through that process.
Yeah. And more than that, you got to know what are your goals for your company and this asset and this investment, and what are your targets, and what will be the obstacles of those targets, and make sure that you're at the indicative terms negotiating those up front as to where control lies, when will it shift, what are the triggers that would cause it to shift, and make sure that those all align with your business plan, and it's not going to be an issue down the road.
Yeah. Now I saw that obviously you're in my backyard here, which is awesome. But you're also looking at Texas and the Carolinas. Is that accurate?
Yes.
You have assets there now, or are you just starting to spotlight it?
No, we don't own anything there currently. We do bid on a number of assets there, but again, being in strong markets, it's a very competitive environment. And as you branch into a new market, it is a challenge getting your foot in the door.
Right. Yeah, we've got assets in both those markets, and they're just absolutely fantastic markets. So it's great that you're doing that. I wish I had more here, though. I gotta tell you, I hate being jealous, but I'm jealous. I'm definitely jealous of the fact that you've got some Class A, really good looking stuff here. Well, listen, guys, I really appreciate you being on the show. Very impressive with what you've put together. Let me ask you this. Are you considering a vertical integration at any point, or you just want to go full blast on acquisitions and asset management?
At this time, we're not really considering vertical integration. When we cross that road, the first thing we'll probably bring in house is the construction team. Right. But again, I had a vertically integrated kind of company on the construction side. And with that, scale of operations comes a lot more work. And I don't want to pull focus away from, asset management and acquisitions, especially when we have a great third party team right now.
Yeah, no, that makes sense. Yeah, I kind of put you on the spot because they might listen to this episode. So I'm sorry about that. After I asked her, I'm like, shit, why'd you ask that stupid question?
Oh, that's all right. Keep the pressure on them. Make them, earn the business.
That's true. Absolutely true. So let me ask you this, guys. I mean, you guys are rock stars in the business, and I have a lot of listeners that are aspiring multifamily investors. They know they want to get into this. Maybe they're analytical, cotton analysis paralysis. Maybe they've done a little passive investing, maybe not, but they really are thinking active. Most of the people listening to my show are more active. What suggestions would you have for someone that hasn't pulled the trigger yet? What advice might you give them?
You gotta have the plan first, and you gotta have the team. So when you do pull the trigger and you do take action, you're able to pick up the ball and run with it, and you don't stumble out of the gate. I think being on the active side, it is, a great opportunity, and there's great things happening, but, it does come with a lot of work and a lot of responsibility alongside of that, outside of, being on the passive side.
Right.
But again, it's a team sport. You have to have a team that works well together and understands each party's roles and responsibilities. So when you do get in front of it, you can take it and run with the ball.
Yeah. When you guys were
My advice,
go ahead, please.
my advice would be network. I think you've got to surround yourself with people who are actually doing it. Otherwise, you'll always sit on the sidelines. I think that was really helpful for me in the beginning, and see it time and time again. Once you surround yourself with people 1 or 2 steps ahead of you, stuff just happens.
Yeah, no, I couldn't agree more. You guys don't know this. I actually mentor students, and we've got, I don't know, close to 1,000, I think, around the country. And I'm really proud of something. They own, I think, pushing 60,000 doors now. I've been teaching a little over 4 years, so really proud of that. But I did that team dynamic in that group where they get together and they can share notes and congratulate each other, and they're not around people that are afraid of what they're doing and negative as well. It's just an incredible dynamic that speaks to what you just said, Warren. It's just very, very, very powerful. So let me ask you guys, I'd like each of you to answer this question. As you were just getting going in this business, or at any point, really, any point in your real estate career, did you have any epiphanies? Were there any like aha moments, like, okay, now I get anything like that come to mind when I ask that question?
I don't know if it was, I'm not sure if it was a single moment or something that happened over time, but I think you kind of touched on it a second ago, Rod. Mindset is everything. Yeah. For some reason, it's very easy to doubt yourself. It's very easy to think that you're never going to be able to win a deal. But as soon as you can wipe away those negative thoughts and just be certain that you're going to make a success of it, stuff tends to happen. Yeah. And I think we were very surprised. We had a really successful 2021, much more successful than we ever imagined. But I think that momentum all just started with that first deal and having a positive mindset.
Yeah. They hear that on this show all the time, because that's really my biggest shtick. How about you, Ryan?
Yeah, that is true. It is about mindset, especially in real estate. It takes grit. It's very hard to get started. You spend a lot of time getting your teeth kicked in and picking yourself up off the mat. But to have the positive mindset to get up and do it again the next day, that's really what it takes.
Do you feel like your GC role in a previous life, or in current, still using it, helped you significantly in what you're doing now?
Yeah, I think it does give us a leg up in, accurately assessing, the cost for projects, and then the potential for cost overruns. I see a lot of people that don't have the relevant construction knowledge to really understand the execution risk and the potential to blow a renovation budget and ruin the return on cost metrics. Yeah, for sure. So what's the driver? Let me ask a different question. How do each of you define the success? What's your definition of the word success? Warren, you first.
Ooh, tough question. I think both of us are after freedom to spend with our families. I've lived through this for 20 plus years where I traded time for money. So I really want that time freedom. I think success is when I can have a successful business, but equally have a successful family life and do everything I want to be doing, not be tied to a desk or tied to a job.
Great answer. How about you, Ryan?
Yeah, for me, success is pretty simple, and it's just a measurement of what you set out to do and what you achieved, and if there's a delta between that. But the real distinction is if there is a delta, you can get up the next day and push a little farther. Be a little better than you were yesterday.
Okay, so it's a continual improvement. Okay, fair enough. I think that's a pretty good place to stop. I really appreciate you guys coming on the show and sharing your knowledge. And it's great. Next time you're in Sarasota, please let me know, because this is my stomping ground. So it's very much a pleasure to meet you both, and good luck in all you do, my friends.
Sounds great. Thanks a lot.
All right, take care, guys. Thanks.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345, and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.